Thank you, RHB, for having us here. I think today China Aviation Oil needs very little introduction. We have been listed on the SGX since 2001. But I think today I'm here to essentially tell you that since our restructuring 10 years ago in 2006, we have become a very, very different company. With our corporate restructuring in 2006, we saw the change in management, the entire board of directors, as well as essentially our majority shareholder. Today, we have BP, an oil major, as a shareholder. We also continue to be supported by our parent company, China National Aviation Fuel Group, who essentially owns all of the aviation infrastructure across the PRC. From day one, we've always functioned as the key supplier, if not the sole supplier of jet fuel to the Chinese aviation market. So over the last couple of years, we have essentially, enjoyed the growth of the Chinese civil aviation industry. And with that growth supporting us, we have also gone out globally, outside of mainland China. So today, you will essentially find us in Hong Kong. We are the third licensed refiller at the Hong Kong International Airport. We are also in Europe, we are in London, and we are also in the Los Angeles Airport, as well as Hawaii and Anchorage, several airports across the world. Outside mainland China today, we are in 46 international airports. We supply jet fuel to 46 international airports outside of mainland China. Within China itself, we supply to all the international airports across China, and currently there are 56 international airports in China. I'll go into details about our business model for our China business, which is essentially quite different from that of our international business data. With the huge supply base, even from China and now globally, that makes us the largest purchaser and supplier of jet fuel in the whole of Asia Pacific. And many of our shareholders have been, warmly rewarded over the last 2-3 years with very firm dividend stream. We have adjusted our dividend policy to essentially 30% payout ratio. 30% of everything we make goes back to our shareholders. So what we have today is 10 years on after our corporate restructuring, a management team, a board of directors that is very, very clear that their vision, their purpose is to create value for their shareholders. Okay? Last year, we clocked in our record year. We clocked in 88.9 million in terms of profitability. And just today, we received news that we are also a Forbes Global 2000 company, meaning to say that we are one of the most valuable companies in the world, according to Forbes. Very broadly speaking, Very broadly speaking, our business can be looked at in 3 broad segments today. This is very, very different from our initial days in 2001 when we got listed on the Singapore bourse. So this is very different from day one when we were listed in 2001 on the Singapore bourse. Today, what we have is essentially jet fuel supply and trading, where we continue to function as the sole supplier of jet fuel to the Chinese market. We have also grown internationally through aviation marketing, in which case we are in 46 international airports outside mainland China. In terms of revenue contribution today, international revenue now contributes something like 56% of our total revenue base. And with China contributing just 43% of our revenues. And this compares against as recent as 2010, where 80% of our revenues comes in from China. So there you can see how we have actually gone on the globalization program. Today we are a very global company, and part of that strategy was actually driven by our diversification program. Diversification in terms of the products that we handle, diversification in terms of our customer base, essentially growing our customer base. We include more than the Chinese airlines that we started off with, and then also growing our geographic basis to see us in international markets like Heathrow, across Europe, across the US as well. And then a very significant part of our business strategy was along the way, we have invested in what we call asset or oil-related assets. And this segment of our business is very important to us because it gives us a very steady, sustainable income stream. And in any one year, we will get 14 million plus minus. In recent years, it has been more. In terms of contribution from this oil-related assets. We report in US dollars, so that's $40 million plus minus as a regular income stream, out of which we are committed to pay dividends back to our shareholders. So we operate a very asset-light business. We see ourselves as a supplier of jet fuel rather than a trader of jet fuel. But with the cash, with our cash haul, we have been investing in oil-related assets. A little bit about our diversification strategy. We essentially started our gas oil book, our fuel oil book, aviation gas book, as well as our crude oil book post-restructuring. And a common take is that these are all transportation fuels. In the oil and gas industry, transportation fuels is backed by huge consumer demand. And this is the segment of the oil market that will see phenomenal growth going forward with the growth of the middle income, the growth of population across the world and so forth. And I'll show you later on, just simply aviation growth, which will essentially astound you, on the kind of organic growth that CAO is, at hand of and able to see. A little bit about our parent company, China National Aviation Fuel Group Corporation is essentially a large central SOE, and it's directly held under TASAC. So we are an SOE, Chinese SOE, all right? In itself, it's a Fortune Global 500 company, and it owns the extensive sales network, logistics, all the infrastructure assets in the airport facilities across China. In itself, CNAF supplies the domestic side of the business. Essentially, they supply jet fuel into the domestic airports. As a subsidiary, China Aviation Oil supplies to all international airports, what we call bonded fuel, which is essentially free of tax. Okay. BP is our strategic business partner. From BP, at the onset of restructuring, they have brought onto the table their best-in-class risk management strategies, their best-in-class trading methodologies. So today, what you find at CAO is essentially the best of East meets West. We are a very international company. We have also, from the onset of our restructuring, assumed the best-in-class corporate governance and transparency of Temasek Holdings. Temasek Holdings came in with a 5% stake, and although they have divested, but our board representatives remains. They are normally board representatives has remained with us to this day. So we are very much a Singapore Inc., all right? But yet assuming the international expertise of an oil major BP and supported by the strength of a Chinese SOE. A little bit about our assets. Essentially, these are the assets owned by our parent company across China. And the nature of the business is that the barriers to entry is phenomenally high because infrastructure is so interlinked with jet fuel supply. Okay? In China, we essentially have very much of a monopoly. In Singapore, it's also very much of a monopoly held by CAFI. Although in recent years, the structure has changed somewhat, such that China Aviation Oil today can supply into Singapore Changi through a member company, Singapore Petroleum, who is a member company of CAFI. So the structure of aviation, the structure of airports across the world varies. In China is a monopoly, in the US is an open economy. And the structure of that essentially means that you need to have the backing or a ready backing of demand. And we easily have that. We have Chinese Airlines demand backing us up. And with that, you apply to become a member of Let's View, for example, and supply into the Los Angeles airport. In Europe, the structure is very much like Singapore, somewhat closed, all right? But later on, I'll show you why the opportunities is really opening up for China Aviation Oil. It's something that I call jet fuel flows, international jet fuel flows. We have been a key supplier of imported jet fuel in China, and this essentially provides approximately 30 to 40% of China's total jet fuel demand, and this is on a cost-plus basis. Okay? We supply mainly to the key international airports. In fact, all international airports across China will have to use our fuel, all right, because we are the sole licensed importer of jet fuel into China. And we also made strategic alliances with major Chinese airlines who supply jet fuel outside of China. So our initial strategy was essentially to ensure that we are at the receiving end. We are across many, many airports to support our customers, the airlines. Over the last 5 years, I would say, we have been building an integrated supply chain, all right? Because ours is a business that is packed to economies of scale as well as cost synergies, okay? For example, we bought a storage facility in Korea, and today, having penetrated the US market, it is cheaper for us to ship out of Korea to the US than out of Singapore to the US. And we have sizable volume in such a way that we can charter a whole VLCC by ourselves. And this is a big difference from our initial days where we haven't got ample volume to, say, the US, and we have had to share, you know, VLCC freight and so forth with others. Okay? So essentially, we are operating on an entirely different platform today from years ago, you know, even at the point of our restructuring in 2006. A salient part of our business is actually trading. And trading, I'd like to essentially give a little bit more color because investors typically think of trading as high risk and, you know, I wouldn't go near it with a 5-foot pole. Our trading, 90% of our total volume traded is actually backed by physical volumes, meaning to say that we have to lock in, our traders have to ensure that there is demand and there's a demand contract having signed before they go out and procure that volume. And we will take delivery, we will ship, you know, and take delivery and ship it to our end market. So 90% of our total volume is done that way. 10% is essentially paper trades. And this is where the traders do what we call trading optimization, all right? Now, in terms of trading optimization, what does that mean? It essentially means that they look at the forward curve. All right, in a contango market, we would typically try to lock in our volumes as quickly as possible in order to ride a contango where the future prices is higher than the current prices. In a backwardation market, we would essentially procure our volume as close to delivery time as possible. And having oil-related assets globally is a strategic investment for us, because just as an example, if we are in a backwardation market today, what we will do is procure as late as 2 to 3 days before delivery time out of Korea and ship in China. It just takes us 2 to 3 days. So again, we will benefit from a backwardation spread. So this is just, to give a little bit of color how we do trading, all right? Typically, in terms of trading, we get 2 to 3 months rolling forward volume, all right? The price is fixed at N-1. So for example, this is June, so by now we should roughly know August delivery commitments. Traders can decide whether or not to procure the X volume today or later. If it's a contango market, we will trade today. We will procure that volume today so that we can ride out the contango play, because price is fixed at July's price. If it is a backwardation market, we will procure in August. Because price is fixed at July's price, it would have been August pricing would be lower. So again, back to the earlier presenter, we always go on a low. So in other words, it means that our jet fuel business will never be in the loss, okay? Because we are always backed by this cost plus, and we are always backed by either contango or backwardation play. Now that 90% of total volume being backed by physical volume, that is actually a very important and significant risk management tactic that our shareholder BP has actually taught us, all right, since their involvement 10 years ago. So this is just structure, but just wanted to clarify that our kind of trading is essentially pretty low risk if you look at it. Earlier on, I spoke about jet fuel flows. We spoke about the different, essentially, aviation market structures across the world. All right. In Europe, is essentially a rather closed market for us, where only the consortium members can supply jet fuel into their airports. But things are changing. Why? Because the European refineries have been shutting down. Okay? Only 12% of every barrel of crude comes out as jet fuel. And jet fuel is essentially a what we call middle distillate in the oil space. All right, and because it is driven by huge consumerism and demand, it sees it is essentially sustained a pretty high price. Okay. Today, Asia Pacific is supplying northwards into Europe. Because of the shutting down of the European refineries, Europe is no longer self-sufficient in terms of jet fuel. And yet, Europe is the third largest aviation market in the world. All right, the jet fuel has to come from somewhere, and today we are supplying northwards into Europe. Okay. The US, with the Jones Act, the West Coast is not able to obtain jet fuel from the East Coast. Okay, the Jones Act essentially means that they have to charter US flag vessels. All right, and the US, as we all know in this space, they haven't had, their bunker business is not great, all right, today. So it's easier for the West Coast to get supply of jet fuel from North Asia. So that's where we are. We are an Asian player, and that's how we have also penetrated the world's largest aviation market. So if you look at it today, China Aviation Oil is where? We are in the world's largest aviation market. Certainly, we have a monopoly in the world's second largest aviation market, which is China, and we are making inroads into the world's third largest aviation market. So essentially our globalization program has been very, very successful. Jet fuel is a generic product. We very recently also went into Russia, all right? Russia has been one of the last frontiers for jet fuel. Why? Because they use Russian jet, which is essentially different from our international A1 jet. But they have started because they have started to use Boeing. And once you use Boeing, you use A1 jet. So we are dealing with a globalized product, and that early recognition of that has essentially enabled us to make inroads into the global arena as far as jet fuel is concerned. Earlier on, we spoke about how our investments in oil-related assets gives us a very steady and recurring income stream. One of our very important or key asset is actually Shanghai Pudong International Airport, the exclusive supplier of jet fuel into SPIA, right? SPIA for us, it owns all the refueling facilities at the Pudong Airport, and the Pudong Airport is today the world's fastest growing airport, all right? And Pudong, if you look at our numbers and our financials, with the expansion of a fifth runway by the end of this year, as well as the inclusion of a satellite hub by the end of next year, it's the only airport in that area with room for expansion. The other airport, Hongqiao, is landlocked, so there is no more room for expansion. And for airports, you need land, you need room for expansion, just very much like Changi, you know. If you look at SPIA, today it gives us roughly about, earlier on I said 40 million. Last year it gave us roughly about 50 odd million, 60 million. And we report all in US dollars, all right? So it gives us a very steady, recurring income stream that supports us for our onward investments for the group. We also own a 49% stake in a pipeline. Essentially, this is a very long pipeline, a 185-kilometer long pipeline that transports the majority of jet fuel requirements of Beijing Capital International Airport and the Tianjin Binhai International Airport. So these are infrastructure assets, you know. They work 24/7. You know, we are very happy with all these infrastructure assets because we need these infrastructure assets also to transport jet fuel to reach our end markets or the airports, essentially in our case. Storage facilities, 39% stake in a storage facility. This is in Guangxi. And earlier on, I mentioned about OKYC, our storage facility in Korea. So these are strategic assets. As we grow globally, we need base points, we need touch points in order to curtail our costs, bring down our costs further, even as we drive our revenues globally. Our latest addition is actually at the Hong Kong International Airport. We have a 39% stake as the third licensed refiller at HKIA. Today, even though it commenced business only in August 2015, today it has got 17% market share. And it's actually really seizing market share from the executive players who have been there for a long time. A little bit about our financials. So this is actually Q1 financials, all right? The net profit has been sustained. It's grown up 4.7% at 25.3 million, and gross profit has been up 17.4%. Now, our gross profit, if you look at our P&L, our gross profit is actually proxy of our trading business, all right? How much money we can make from trading optimization is all in there. As well as our supply business, the more jet fuel we supply internationally, the more money we make, and that's all locked into our gross profit level. Then after gross profit, we have share of results from associates, which essentially, as I mentioned earlier, clocked in at least 14 million plus minus on any given year, and then we have our net profit. So that is a somewhat different P&L, but just to make sure that we sort of understand that. So in quarter one, SPIA's profitability, or rather share of results of profits, contributed some 13 million, and OKYC, which is a strategic investment for us, contributed some 1.3 million. Total revenues essentially grew 126.1% year on year, and this is as a result of us entering into new aviation markets globally. We grew our access into international airports from something like 38 to 46 during the year. Volumes increased year on year at 49%. This is actually as a result of diversification. I mean, apart from jet fuel, we also have got business in crude oil. We supply crude oil to the teapot refineries in China today. And why is that? A lot of analysts ask, why are you supplying crude oil? It's not a transportation fuels. What we are going after is actually essentially the refineries offtake. Only 12% of that per barrel of crude comes out as jet fuel. We want that jet fuel. So today, we are helping the Chinese refineries export their jet fuel into the global aviation markets that China Aviation Oil, has penetrated. So that's a business model. Middle distillates essentially is gas, oil, and jet fuel. We saw with our increase in gas oil books in the first quarter, the middle distillates volume going up 89.6%. Now, revenue is of course a proxy of oil price. Okay, so essentially that's something that we all need to remember, because there were times when the oil price, with the oil price slump, despite the volume increase, revenue actually came off. Other products revenue went up some astounding 344.1% year on year, and that's as we essentially build structural advantage, got more business in fuel oil, crude oil, gas oil. Earlier on, I mentioned essentially today we have got 44.5% of our revenues coming in from China, and this compares against 80% coming in from China in 2010. Net profitability and gross profitability profile, as you can see, we have been, and this is all in US dollars, in millions. Last year was a record year for us. We clocked in 88.9 million in terms of net profitability, out of which our trading book clocked in 44.1, our supply and trading business clocked in 44.1 in terms of results from associates. Okay. As you can see, this over the last 5 years, it has been a very steady state, steady recurring income stream of plus minus 40 million. All right, last year 66.4 million. All right, came into our books because of our investments, and this essentially came from Shanghai Pudong International Airport. of our financials, in terms of our P&L. In terms of our balance sheet, we have got 276 US million in cash and equivalent. All right, so we are at a point where we want to grow more, whether both organically as well as inorganically. Just earlier on, no borrowings, very little borrowings. This is all short-term funding. All right, the gearing is non-existent. And so today, I'm here to essentially, share with you how different we've become, since our initial listing in 2001. You are looking at a very, very different organization today. All right, an organization that's very, very focused in driving profitable growth and delivering sustainable value for our shareholders. That's a key objective that management and the board of directors have. So I'm going to leave you with this rather thought-provoking slide. Today we've got 55 aviation megacities in the world, okay? And CAO is in 47 of them, all right? And aviation megacity is defined as 1 million daily passengers. Okay? By 2035, Airbus expects 93 aviation megacities in the world. And we can all comprehend that as taking to the skies, flying becomes very commonplace for us. Okay? And CAO wants to be there, and that's the reason why we have been showing out our cash reserve. Whether we are growing organically or inorganically, we want to grow. Okay? And that concludes my presentation this evening. I'll be happy to take on some questions that you have.
If there's no question, okay, that's all. Go on. We have a question.
Good evening. So I have one question. Just now you say that in China market you are a virtual monopoly in the aviation market, but just now when you the slides there was a figure of your market share. You say that your market share in China aviation is about 30 to 40%. How does it work out to be a monopoly?
The rest of it is actually the domestic market. Okay. The entire international market, we supply only to the international airports, because all international airports, by international convention, needs to use what we call bonded fuel, which is essentially imported jet fuel. So the remaining 60–70% is actually the domestic market, which is supplied by my parent companies in there.
Okay,